I'm going to break down the ultimate tax strategy to save you a ton of money in taxes. Let's start right now. First is the entity that you're using. So if you're a sole proprietor or just being taxed as a normal LLC, you are being overtaxed. Second is that you should either be taxed as an S corporation or a C corporation. But even if you're LLC, you can choose either S or C corporation as a form of taxes. Let's break down some of those savings. In the case of an S corporation, again, if you have an LLC, you can tax it as an S corporation. You can save a lot of money because the biggest tax you're probably going to pay is self-employment tax unless you're making more than $200,000. So let's take the example of making $100,000 and 50% is salary, 50% is distribution. It doesn't have to be all salary. If 50% is salary, you're only paying 15.3% on your self-employment on the salary. That saves the 15.3% on your distribution from your company to yourself, saving you $7,650. That's just your one saving right there. And now a quick message from our sponsor. Myself, we actually save business owners just like you a ton of money in taxes. And we have found that over 90% of business owners are overpaying. That's horrible. So you'll see a link in the description or in the comments, either one. Click on one of those and we'll see how much money we can save you in taxes, and we'll go through the entire step to see if this is right for you. It's like getting a second opinion. It's not a big deal and it's painless. And our rule is pretty simple. If we can't save you $5,000 or more, our best is over $100,000, we don't charge you. Really that simple. Now, back to number 2. The second biggest way to save money in taxes is by using what's called income shifting. And all that you have to do is take the money you're making and then give it to someone and pay someone in a lower tax bracket. So let me just give you one quick example. So if you have children, you're paying for clothes, you're paying for music lessons, whatever it is, instead of you paying for it, why don't you find a legitimate function in your business, pay your children, and have them pay for it? Believe it or not, by doing this either with your kids, your parents, anyone you may support, and you do this properly, it can be one of the biggest tax savings if done right. It's really important that if you know how to use proper income shifting, you can do some pretty amazing things, especially because you can take assets that have been fully depreciated, you've written them off, and what you can do is there's a little strategy that lets you take those same assets, put them into a trust, and then what you can do is you can rent the assets from the trust, again, changing the way that income is structured. And then therefore, not only can you do that, but then that allows you to keep writing off year over year the same things that you've already fully depreciated. This is one of the biggest things that you can do. Now the third, if done effectively, and of course some people have already heard about Section 179 or bonus depreciation, it's that it's not being done correctly. If you are ready to start making purchases in your business that you're doing strategically based on your income, if you use the right type of financing and setup, not only can you get the maximum tax savings, but you can actually write off your income for years, and all the money you're taking in for years can be tax-free. Now, how do you do that? It's pretty simple. Let's say, for example, you need certain equipment in your business, and it's pretty common, right? You're a business owner, you're gonna need equipment, whether it's trucks, whatever, etc. Here's one thing you can do. If you finance the equipment properly, you use bonus depreciation or Section 179, you can actually finance it, write it off, and then all that income you're doing is tax-free to you. We actually have a client that did this with a very large piece of equipment that he needed in order to grow, and guess what? It was a win-win for him because not only did he land a huge client from purchasing the equipment, but actually the amount of income that he made in the future, he didn't pay one stinking penny on it. That's how important this is if it's done correctly. Now, I want you to help you think through deductions. There's a lot of people out there that at the end of the year, they think they have to buy more chairs, more tables, deduct everything. That's not the proper approach. The question is, does your business need it when you are buying it? And if it does, then buy it. Because here's what's going to happen. If you buy equipment that cost you $1,000, but you really don't need it, sure, you can write off $1,000, but you're spending $1 to save 35 cents. Doesn't make any sense. It's better to use a qualified plan for retirement or put that money in an HSA if you have insurance or an HRA if you're doing some kind of sharing plan. Either way, that's going to help you start writing off more money in taxes. So let's go over this final bit. The 401k IRA, what this does is this can allow you to put away $60,000 tax-free. $60,000 tax-free. And if it's self-directed, you could put it in a myriad of things as long as it's not collectible. There are rules, and as long as you follow the rules, you could sock away a lot of money in retirement. And I don't know if you've ever seen what I'm about to show you right here, but if you look at an actual schedule about how much money you pay in taxes. So taxes are typically 35% aggregate total. And if you can save that money in taxes, you can see how much faster you can retire. In year one, on the left side, you can see in black, this is how much, if you're doubling your money, if you aren't paying taxes, it goes from 1 to 2, obviously. And then on the right side in red, if you're paying 35%. Now look at that bottom line. In year 10, if you're paying that 35% in taxes, you're paying a doozy, because you go from the $2 after year 1 down to $1,000 in year 10. But what happens if you're paying 35% in taxes? Well, instead of having $1,000, you're going to have $140. It's amazing what happens when you start saving money in taxes. You went into business to retire early. If you think about why you're in business, it's to retire early. Use what the government has made for you to maximize your tax savings. Now, the other thing I'm going to talk to you about is with your insurance, or if you don't have insurance and using some kind of sharing plan, some kind of Christian sharing plan, or just any sharing plan, there is what's called an HRA. And this will let you help write off a lot more money in taxes. The problem is that if you're in some type of, if you're with someone who's already helping you with your taxes, you'll discover that you can't write off health insurance unless you either have a C corporation. But what you can do is there's another way to do it, and that's with an HSA or an HRA. An HSA goes with your insurance, and HRA goes with a sharing plan. So if you have a sharing plan, that's where you really want to go with this, because you get, this is the only type of money that is no tax on the way in, no tax on the way out. Very, very effective. So if you don't know how to write off taxes for your health insurance, I can show you how. You have to use another entity with your main company, and then that allows you to write it off. The other way to do it is, again, if you don't have insurance, if you're having a sharing plan, use an HRA. It's a health reimbursement account. It helps you reimburse yourself for that sharing plan. Very, very effective. But you have to use the other layer, the other entity, which can, again, maximize your tax savings. So let's put this all together for you. The entity that you're in, shifting your income properly, using income from active to passive, and that's by using trusts, maximizing your deductions the right way without taking deductions you don't need, an HSA or an HRA, qualify retirement plans. But here is the big thing. You are not an expert in taxes. Matter of fact, not many people are. And what you should do is see if you can get a second opinion to see how much you can lower your taxes. It doesn't take that long to do. There is a link in the description. Click on that, and we're going to see what we can do to help you lower your taxes.